So let me propose this question to you. You have a 50-50 chance to either double your income or lose 1/3 of your income. So think to yourself right now, would you take this opportunity to possibly double your income, but on the other hand, lose 1/3 of it? So think about this for a second. The factors are definitely in your favor. It's not like you're losing half of your income, you're losing 1/3 of your income, and if you win, you double your income. So why or why not would you do this? Think that to yourself right now. And now, as investors, this is a psychological advantage we can take over other investors. So in 1995, the University of Michigan had an experiment. The experiment was giving people a 50-50 chance to either double your income or to lose 1/3 of your income. Now the results of the experiment found out that the overwhelming majority declined this opportunity, and the reason because humans hate risk. And as investors, we have to overcome this and overcome this emotionally. Later, the university proposed the same thing, except you triple your income or you lose 1/3 of it. Once again, the overwhelming majority opted that they would not do this. Now as humans, the psychology of risk scares us to death. The psychological barrier is so big that so many people who start investing and start losing money, they quit altogether because they just can't take it mentally. As investors and traders, you have to overcome the psychological barrier and think to yourself, is the risk reward worth it? This is something that I always think about while going into a trade. Okay, there's a 60% chance that I'm successful in this trade from the research that I've done. There's a 40% chance that I lose half my money in this one. So is it worth it? It's possibly worth it. It wouldn't be like a mid-conviction trade. I call a high-conviction trade like 70 to 80% that I'm confident. But that is why a mid-conviction trade is worth it. If you win 60% of the time and you lose 40% of the time, you're gonna be crazy rich. That's what a lot of these investors don't realize. Risk scares people to death, and we have to overcome this as investors. So I have a lot of thoughts that I'm gonna be telling you guys in this video on the emotional side of investing and how you can benefit from this and use it to your advantage. And if you should have your portfolio diversified, centered within one stock, centered within a few stocks, I'll tell you guys my thoughts on this exactly. So let's get into the video. So like that question I brought up at the beginning of the video, most people would not take that risk. Your portfolio is kind of like your income. It's kind of like your baby. You don't want to lose it. Losing it scares you to death, but you also want to win, right? So you always got to look at the risk-reward ratio. So let's talk about diversification real quick. Should you have a portfolio that is heavily diversified? Should you be investing in index funds that cover the whole S&P 500, that cover the whole US stock market, or cover the whole international stock market? Is this smart to do? Now, if you're an investor that is not very knowledgeable, if you like a passive way of investing and just kind of set it and leave, index funds are always a great option. Index funds have taken off the past few years, and studies came out that only 37% of professional money managers outperformed the S&P 500 over the last 10 years, which is insane. So what should you do in your portfolio? It depends. So first of all, if you're near retirement, if you're in your 50s, diversification is an amazing thing. You can never go wrong with diversifying late in your age, just trying to preserve your income and also make some gains off of it. On the other hand, if you're super young, let's say you're in your 20s, concentration builds wealth and diversification protects it. So that is the reason that as a 50-year-old, you should definitely protect your income. But as a young investor, if you're in your mid-30s or below, I recommend that you are pretty concentrated in your investing. Pick 5 stocks that are your favorite, that you believe are the best value and have the best growth opportunity, either short-term, long-term, have a thesis behind every trade. And think about the S&P 500 for a second. If you invest in SPY, the index fund, you own a part of all these 500 companies, whether you want to or not. Why not build your own type of index fund and just buy and hold? Why not have your 5 favorite stocks just diversified into those 5 and not diversified over 500? You got to build your wealth and not protect it if you're looking to have some very big gains. So let's say last year you look at Apple stock, ticker symbol AAPL, and you said, oh, I love this company. I think it's going to outperform the S&P 500. So you throw all your money into this one stock of Apple. From exactly 1 year ago today, if you made that investment, your investment would now be worth 80% more. So if you put $100,000 in it, you would be up $80,000. Now if you're in the S&P 500 and you bought that index fund, you would be up a measly 5%. So look at that difference. Apple is at the top of the S&P 500, but the fact that the S&P 500 also includes these smaller companies that you have no interest of, that you don't know about, that you have not done any research on, why would you be throwing money into them? As an investor, I've always struggled with the idea of diversification. I've held index funds before because I thought it was a smart thing to do, which it is very smart if you're looking for passive. But if you're a good researcher, if you know your stocks, why not find your 5 top stocks, diversify your money to them, and then put that in a set and leave a portfolio. Now you can still have day trades, swing trades in another portfolio, but have your lockbox portfolio set up with your 5 favorite stocks. It doesn't have to be 5, it can be 3, it can be 10, but just have your favorite companies And forget the S&P 500, forget index funds. This is my way of investing. I pick stocks that I love long term, that I believe should outperform the market by a big margin. And why diversify if you have a strong thesis towards these stocks, but you don't have a strong thesis behind every single stock in the S&P 500, which I know you don't. If you love the FANG stocks, why not put all your money in there? Why not invest in Google, Facebook, Apple? That would have destroyed the S&P 500. If you love Tesla stock, boom, your money's up 500% this past year. Why settle for less when you can build a crazy amount of wealth with an easy strategy of just picking stocks, set it there and leave it, and not diversifying, not worrying about diversification? Some of the smartest investors in the world have always preached diversify, diversify, diversify. I heavily agree against this, and I've always wondered why they say this. Now, like I said before, if you're looking to preserve wealth, it's different, but if you're looking to grow wealth and get rich, you gotta be concentrated on your stock picks. In my portfolio, I almost never have 10 different stocks that I'm invested in. I usually have different positions, different options on these stocks, but I usually am watching about like 10 stocks super closely. I know everything about the business, and these are the ones that I invest in because I'm confident in myself, I'm confident in my stock picking, and I'm confident in my strategy. As long as you know your stuff, you do not have to be diversified. Diversified is one of the biggest myths in stock market investing. Now, you'll always come across people who just tell you, you have to diversify. Man, if you're not diversified, if you own 2 stocks, there is something wrong with you. Now, shrug those people off. They do not know your stock picking, they do not know your portfolio. If you believe in Apple stock, like it's the gem of the century, put all your money in Apple stock and put that away, set it and leave it. Make that your index fund, just straight in Apple. Now, I'm not advocating you do this, but that is certainly a viable strategy. Now, it's always good to have some different sectors, even if your portfolio is very small. You can never go wrong with diversifying into other subjects, but that is not essential if you believe in the company, and it's a very solid company. Now, it's super risky to go all into one stock. Anything could happen. Any bad news could come out and drop your money to the floor. So in that case, I would not put all your money in any small cap companies, but diversify over 5 big caps that you love. If you think Boeing's gonna bounce back super hard, put some of your money in Boeing, put some in Apple, some Google, some Tesla if you think Tesla's gonna be amazing over the long term, which it probably will. And then with the other ones you believe in, but they're more short term, have a different portfolio for that. Have a spot where you have all your speculation stocks, and then have your lockbox of your self-made index fund. Now, I'm not telling you guys to do any of this. This is just my opinion. I'm just letting you guys know what I do myself. Usually in my long portfolio, I'll usually have about 5 positions. Now, it changes sometimes as my thesis changes, but you will have no regrets. If you pick a stock, buy and hold long term, like with Apple, you would have been up 80%. There was almost no risk with Apple investing last year. What's gonna go wrong with Apple? Apple kind of owns the phone world, and they're only growing as a business. Bad news could come out, but is that really gonna be that bad? Is a company like Apple not gonna be able to bounce back from that? They will be able to bounce back because it's Apple. And that's something you have to realize. Diversification is not essential for any investor who is looking to grow their wealth by substantial margins. And as investors, we have to look at the risk-reward ratio. Like I was saying in the beginning question, most people do not take the risks that you need to take it to the next level. So let's look at Tesla last year. Tesla, let's say at 300, you look at it, you say, oh, it could go bankrupt, they could be a failure, everything's not gonna work out. But on the other hand, it could go 500% from there. And so you look at that, you're like, oh, it's 70% chance that they go big or 30% chance that the company fails. So is it worth it? Of course it's worth it. You have the potential to 5x your money at that point, or you have the potential to lose half of it, but just the odds are in your favor in these investments, and you have to take that to your advantage and get over that psychological barrier which is scaring you, and you're being scared of risk. So you have to get over that barrier, and then you can take some risk. Make sure it's calculated risk, make sure you've done all your research, and always make sure you know what you're doing as an investor. Now, if you don't know anything, if you don't know what you're doing, it's always solid to invest in an index fund. I have nothing against index funds, but as an advanced investor, it's always smart to look past diversification and more on concentration. So that's all I have to say in this video. Hope you guys enjoyed. Hope you got some value out of this. I'll quick plug for Webull. If you want 2 free stocks on Webull, one is valued from $14 to $1,400. The link is down below. And if you want to join the private stock group, it's $9.99 a month. You have a portfolio update every single day. You get messages every time I buy and sell a stock. And we have a community of over 800 investors that all work together, all find out these ideas, and we're all just growing our portfolios together. So it's awesome. So I hope you guys enjoyed. And I hope you had a great week of trading. Let's get rich.